Kathleen is still here as well. And we're joined by Gary Pollack. He helps oversee $12 billion as head of fixed income trading for Deutsche Bank's private wealth management. He believes tomorrow's two-year auction will do the best this week. Gary, thanks for joining us. It's interesting that we get week after week of record numbers here as far as supply goes, and demand still holds up, as Brian points out and as we pointed out in one of our top stories today. Do you expect that to continue?
Matt, it's a great question, and every time we do have an auction, we're always going to ask the question, will foreign participation show up because they're the major buyer of our debt? For this week, the answer is yes, they will show up. Yields are higher than where they were a couple of weeks ago. We haven't had an auction of Treasury notes or or bonds for a number of weeks, so here's an opportunity to buy U.S. Treasury debt at higher yields. You haven't had it in a couple of weeks.
You know, I just want to put a plug in for Treasury Direct, because I'm sitting here listening to Brian telling us about the TIPS auction, all the supply coming. And isn't it true that regular people can actually buy this stuff if they want to directly from the Treasury, no cost? The Treasury holds it for you for next to nothing. But would you recommend regular people buying government paper right now?
Why not, Kathleen? Certainly a two-year note yielding a little over 1%. With Fed monetary policy, unchanged for the foreseeable future, it's not that bad a yield. I know 1% seems rather low, but over the next 2 years, it's not a bad investment.
But what about people talking about, we have hedge funds getting set up for hyperinflation. Even if it's not around the corner, for tomorrow, for this year, for next year, isn't it a concern, especially for a regular retail investor who's not going to be trading as much?
Absolutely. And, with inflation low, it'll probably be low again for another year or so, Matt. But long term is more than a year. Inflation will be heading higher. TIPS are a good idea. Commodity prices are a very good idea. Other type of instruments that are sensitive to inflation, that rise with inflation, even real estate, is not a bad idea from a long-term inflation play.
And you can buy TIPS from Treasury Direct. You can go on the website. I just want to remind people, because it's, as a former bond bell, bond babe, et cetera, the regular person doesn't have to pay a broker to buy this stuff.
All right, we're going to take a quick break, and we'll continue talking about this. Gary's going to stay with us, Kathleen as well. Brian Luke's still out there at his... All right, we are back with Gary Pollack. He helps oversee $12 billion as head of fixed income trading for Deutsche Bank's private wealth management. Kathleen Hayes also on set with us, and Brian Luke following. Well, bonds are really a way of life for Brian Luke, sitting there at the market desk. Let me just quickly, talking about supply, I want to ask Gary first, how much more supply do you think we're going to see coming online? Because we've seen the Fed's balance sheet kind of calm down a little bit. But a lot of people are saying there's still a lot more money to be spent. People are talking about a second stimulus. How much more does the U.S. need to sell to fund everything we're doing?
Well, right now, I think the amount of Treasury debt that has been sold is a little over $1 trillion. And the estimate is for the federal budget deficit for the fiscal year ends September 30th, about $1.5 trillion. So you have another $500 billion worth of bonds to be sold between now and September 30th. So that's a lot of bonds.
Hey, Gary, let me ask you a question. This is Brian Luke. Today's News Bureau, our Bloomberg News Bureau, put out a 5.1% article about the real yield. Now, today, though, when you buy Treasury TIP and Treasury inflated protected securities, that's only offering about 2.4% yield. And I know there's a lot of confusion in the marketplace about what the real yield is versus the TIPS yield. Do you have any comments about that, and whether you think 2.4% is, significantly discounted, or if it's fair valued?
Well, Brian, as you pointed out, 2.4 is sort of the trading range for the 20-year TIP over the past year or so. And the unique thing about TIPS is that the investor gets 2.4% plus whatever the change is in the CPI every 6 months. So it is a rather unique instrument that almost guarantees an investor a hedge against inflation. Again, it's 2.4 plus the change in inflation. So if inflation gets very high, 2, 3, 4%, the investor is getting that 2.4 plus whatever that change of inflation is. It's not a bad deal.
And people who are worried about inflation, the bloggers worried about inflation, 2, 3, 4% is not the high that they're talking about. People are concerned that maybe in 2 or 3 years inflation could get much higher than that.
Yes, right. 2 or 3% or even 4% inflation isn't bad when you look at the long-term history of inflation in the United States. What gets bad is 6, 7, 8%. These are very high levels of inflation.
There's a reason, haven't the bloggers ever heard about bond market vigilantes? The bond market's going to go to the moon if the Fed lets headline or core inflation start to move up like that, that's going to taint the economy. It seems to me that that's what the bloggers must totally not see, that the bond market's just going to roll over and play dead and not put the brakes on the economy and not put the brakes on inflation if the Fed doesn't do its job, which the Fed says it will.
Excellent point, Kathleen. The bond market is extremely sensitive to any hints of inflation. And as you point out, as soon as it smells it, interest rates are going to rise, and they will continue to rise until the economy slows down and stops inflation. So that's something to look forward to.
Yeah.
Is there, though, you know, a lot of people will come on and talk. David Malpass wants the Treasury and the Fed to start talking about real strong dollar policy, but they don't really want a strong dollar, do they? I mean, devaluing the dollar seems to be the sort of assumed way out of all of the debt and problems that we have here.
Well, you know, again, a strong dollar is going to hurt our exports, which is going to hurt the internal economy. And I would think right now the important focus of policy, both fiscal and monetary, should be to stimulate the economy and get the economy on a strong track. At another point in time, the Fed, as our monitor of inflation, has the additional responsibility to keeping inflation stable to make sure things don't get too far out of line. So a short dollar or a weak dollar is not going to help us right now in the immediate term.
They wouldn't be, though, concerned with 2 or 3%, would they? I mean, don't you think Ben Bernanke would trade that for growth?
I think he probably would. Would the bond market be happy about that? I'm not sure if they would. But certainly 2% real yields would be, real inflation would be okay for the bond market.
And are we talking headline or core? Because when we talk about this 5% real bond yield, it's because consumer prices headline fell so much, but that's because of oil prices. The core is stuck between 1.5 and 2. Do you think the Fed lets it go much? Maybe Janet Yellen has said 2.5 is okay on the core.
Well, again, the core is what the bond market's going to look at. 2% is going to be okay. 2.1, 2.2. You get closer to 2.5, Kathleen. And again, it's going to be dependent upon what other factors are going on with the overall economy, equity prices, what the outlook is. That could be a little bit on the high side, and then the bond vigilantes come in and just stop everything.
What about other kinds of bonds? We've been talking a lot about governments and tips. What about corporates? What about emerging markets? What about distress?
No, that's a very good point. You know, another sector that we like, or we like the most right now, is corporate bonds, investment-grade corporates. The spreads over treasuries are still attractive from a long point of view. You know, they've come in recently over the past couple of months from extremely wide spreads. But we think going forward, corporate spreads can even grind tighter gradually over the next couple of months as the Treasury just continues to sell a lot of Treasury debt. So we are emphasizing an overweight position in investment-grade corporates.
Hey, Gary, you talk about the large issuance in corporate bonds. You also talk about the large issuance in Treasuries, but that's also been mitigated a little bit by the shrinking amount of agency debt sold, the shrinking amount of securitized products sold. How do you feel that those two asset classes, in terms of the bond market, weigh into your overall asset allocation decisions?
Well, as you pointed out, spreads on agency paper have come in quite a bit as the as the Fed has been buying agency as well as mortgage-backed debt in the secondary market. So from our point of view, the additional spread on agencies is really not that great, Brian. For the spread product, again, we like corporates. We think that investment-grade corporates can continue to do very well over the next 6 to 12 months.
All right. Hey, Gary, thanks so much for joining us. Gary Pollack there from Deutsche Bank's Private Wealth Management Group.